Welcome. Today, we are cracking open a really powerful financial tool. It's all about uncovering the hidden risks and, of course, the rewards that are baked right into a company's costs. We're talking about the degree of operating leverage.
And just so you know, this explainer was prepared by Samir Al-Rishni, PhD with AI support. So what's on tap for today? First, we're going to look at the power of costs. Then, we'll get into what operating leverage actually is. After that, I'll show you exactly how to calculate it, and we'll even apply it to a couple of different companies to see it in action. We'll compare what high versus low leverage means, and then wrap it all up with why this number is just so important.
All right, let's jump right in. First up, we need to get to the real heart of this whole thing, and that's the surprising, almost hidden power that a company's costs have over its bottom line. I mean, have you ever seen this happen? You've got two companies, right? Both of them get a nice 10% boost in sales. But for one company, profits just go through the roof. The other one? Profits barely even move. So, what gives? What's the secret sauce here? Well, the answer is actually hidden right inside their cost structure.
Okay, so the secret is all about the mix of two basic kinds of costs. First, you've got your fixed costs. Think about things like rent for the factory or salaries for the office staff. It doesn't matter if you sell one widget or a million widgets, those costs are going to stay the same. On the other hand, you have variable costs. This is stuff like the raw materials you need for each product or the commissions you pay your sales team. These costs go up and down right along with your sales. And it's that specific blend, that recipe of fixed versus variable, that really unlocks the whole mystery.
And you know what? That blend, that mix of costs, brings us right to our main topic today, operating leverage. Let's dig into how this financial idea works pretty much exactly like a real lever.
Seriously, the best way to get your head around this is to picture a physical lever, like from science class. You know, a small push on one end can create a huge lift on the other, enough to move a giant boulder. Well, in the world of business, sales are that small push, and profits, that's the boulder. Operating leverage is the actual lever itself. It's the thing that decides just how much lift you're going to get for every little push.
So if we want to get a little more formal about it, what's the actual definition? Well, the degree of operating leverage, which we just call DOL, is a ratio. And what it does is measure exactly how sensitive a company's operating income is to any change in its sales. And by operating income, we mean profit before you pay interest and taxes. To put it simply, DOL is the number that tells you the size of that magnifying effect we've been talking about.
Okay, that's great, but how do we actually calculate this number? Now, the formula might look a little scary at first, but trust me, we're going to break it down into really simple pieces. Let's start with the ingredients.
All right, so to cook up our formula, we need 4 key ingredients. You'll see how they all fit together in a second. First up, we have Q, and that's just the quantity, the total number of units the company sells.
Next, we need P. That's the price per unit. Pretty straightforward.
Then we have V, which stands for the variable cost for each unit. You know, the cost of materials, that kind of thing.
And last but not least, we have F. That's for the company's total fixed costs. All the rent, salaries, and other overhead rolled into one number.
Okay, let's put all those pieces together. The formula for DOL is basically the company's total contribution margin divided by its operating income. So let's unpack that a bit. The top part of the formula is that contribution margin. To get that, you take the price per unit P, subtract the variable costs per unit V, and then you multiply that whole thing by the quantity you sold, Q. What that number tells you is how much cash you have left over to cover all your fixed costs. Easy enough, right? Then the bottom part is your operating income, and that's just the contribution margin we just calculated, minus all your fixed costs, F. That's really the core profit engine of the company.
Look, theory is one thing, but this stuff really clicks when you see it in action. So, let's make this real. We're going to compare 2 hypothetical companies that have totally different ways of handling their costs.
So let's meet our 2 companies, ABC Corp and XYZ Corp. Now look at the numbers. They both sell 10,000 units. They both charge $50 a pop. At first glance, you might think they're pretty similar businesses. But look closer. Their cost structures are complete opposites. ABC Corp has really low variable costs, but super high fixed costs. You can picture them having a huge automated factory. XYZ Corp is the reverse. They have higher variable costs per item, but their fixed costs are tiny. Maybe they outsource all their manufacturing. Who knows?
Okay, time to do the math for ABC Corp. First up, their contribution margin. That's 10,000 units times the price minus the variable cost, so 50 minus 12. That gives us $380,000.
Next, we subtract their big fixed costs of 100 grand, which leaves them with an operating income of $280,000. And for the last step, we divide that contribution margin by the operating income. 380K divided by 280K, and boom, we get a DOL of 1.36.
Okay, now let's run the numbers for XYZ Corp. And this is where it gets really interesting. Check this out. Even with a totally different cost setup, their operating income is exactly the same as ABC Corp's, $280,000. But when we actually calculate the DOL, dividing their $300,000 contribution margin by that same operating income, we get a way lower DOL of just 1.07.
So let's pause right here, because this is the key takeaway. We have two companies, identical sales, identical profits, but they have very different DOL numbers. ABC Corp is sitting at 1.36 and XYZ Corp is at 1.07. So what does that difference really mean for how these businesses operate?
Well, that question brings us right to the strategic heart of operating leverage. It's all about that classic trade-off between risk and reward. So let's break down what these numbers are actually telling us.
Looking at the chart here, the difference is just crystal clear. ABC Corp's higher DOL, that 1.36, that tells you their business model is built on a foundation of high fixed costs. You can think of them like a rocket ship. Yeah, they have the potential for explosive growth, but they're also way more volatile. XYZ Corp's lower DOL of 1.07, that's more like a steady, heavy anchor. It's not as exciting in the good times, but it's a lot more stable when the waters get choppy. See, this isn't just a number. It's a fundamental strategic choice about how much risk you're willing to take.
And here's the punchline. For ABC Corp, with its high DOL of 1.36, every single 1% increase in sales creates a 1.36% jump in operating income. I mean, that is fantastic when things are going well. But it's a double-edged sword. A 1% drop in sales causes a painful 1.36% fall in profits. It is the definition of high risk, high reward. Now, XYZ Corp, with its low DOL, is much more stable. A 1% change in sales only moves its profits by 1.07%. They're not going to see that same explosive growth, but they are much, much safer during a downturn. It's just a classic trade-off, lower risk for lower reward.
Okay, so we've defined it, we've calculated it, we've seen it in action, so let's bring it all home. Why does this one little number matter so much in the real world?
So who is actually using this stuff? Well, you've got managers. They use it to make huge strategic calls, like should we pour millions into a new automated factory that would lower our variable costs but jack up our operating leverage? Or should we stick with a flexible model and outsource production to keep our fixed costs down? Then you have financial analysts. They're using DOL to predict a company's earnings. A high DOL is a red flag for them that earnings could be super volatile, swinging all over the place with the economy. And of course, you've got investors. They use it to really understand the risk they're signing up for. A high-leverage company, sure, it might offer massive returns if the economy booms, but it could get into real trouble if there's a recession.
And that leaves us with one last really powerful thought. The degree of operating leverage completely changes how you should read a company's financial statements. An income statement is no longer just a boring list of costs, it's a strategic blueprint. So the next time you're looking at a business, ask yourself this: are you just seeing a bunch of expenses, or are you seeing the lever, the powerful tool that could amplify its biggest wins and its deepest losses?